Well, good afternoon, everyone, and welcome, in this case, very much to London, but in fact, Warren's dialing in from Majorca, and we're really delighted to have Warren Mosler here. Warren is a legend in many fields, but we're here today on one. So he's a very successful businessman, very successful writer, not quite so successful as a politician, but he keeps trying hard and running for the US Virgin Islands. What we have him here today is to talk about something I think is dear to all our hearts. Let's get to the bottom of modern monetary theory. And I just love this title today: something old, something new, something borrowed, something true. Now, you'll know me, I'm Michael Mainelli. I'm one of the directors of Zien, and it really is a privilege to be able to introduce so many of these fantastic webinars. And I can only do so thanks to the generosity and tolerance of our sponsors, who allow us to range widely and freely across technology, economics, and finance. Regular listeners and viewers will know the agenda, which is my job is to get out of the way as quickly as possible so that you can hear from our expert, hence no lengthy introductions or anything. I would like to make 3 points before we get going. First point is, yes, this is being recorded, so you can share with friends and colleagues in approximately 48 hours. It should go up sometime on Wednesday afternoon, London. Secondly, we will be sending all of the questions, comments, observations, whatever, to Warren. They will contain your email, so if you want to get to grips with it in some form of detail or ask for more information that you don't want to ask for here, he will get all of those. But that means that you do need to use the GoToWebinar question and answer facility. I'm here with you, so I'm not on Signal or Twitter or Tingle or any of the other various ways we can connect. For the next 45 minutes, we're here together. So please get them in, and I will feed them into a conversation with Warren as well. And yes, the slides are, I believe, already posted, and Peter, who's here in the background, will be posting links to Warren's sites and some of the writings that Warren has. Now, I am particularly interested in this subject because I kind of came at it in a very odd way, studying Jevons' work in the mid-19th century, and later moving somewhat into the Austrian school, which has some relations to what we're going to be talking about today. But I personally think that MMT of the old form, and remember, modern monetary theory is older than it looks, it has just been recently appropriated by politicians. The older theory had a lot going for it, not least a fairly basic understanding of what money is, which is sadly missing from much of economics. So I have a genuine sympathy to listening to this argument, and I would ask you, listeners, to cut beneath the politics and to listen to what Warren's saying from the point of view of an economist examining this. So Warren, with no more ado, the floor is very much yours. Over to you.
Okay, thank you very much. I'm going to be racing through this for 20 minutes, so we'll have lots of time for questions. I started coming up with this probably in the mid-1970s. I was at Bankers Trust on the money desk there, involved in Ginnie Maes at the time, were the new derivatives, trading, sales, and I worked very closely with all the other people on the desk. And I developed it entirely independently. I'd never read any of the other economists or knew anything about them. And then I introduced it to the academic community in 1996, and they started digging into things and came up with some, did the research and came up with information that I'm going to be relaying to you here when we talk about something old. So if we skip to that slide, please. Keep going. Got my poll here. Okay. So my wife and I were at Pompeii a few years ago, and we jumped on one of the tours, and the guide at one point showed us some of the coins. They were made out of cheap metal, and he said Pompeii was a very nice place to live because they would collect these coins for taxes, and then they would pay people to do public service, sanitation, public safety, that type of thing. And people wanted to live there even though there were high taxes. And so I was kind of a troublemaker, and I said to the guide, well, actually they would pay the people first, and then the people would pay their taxes. He goes, no. People, you collect the coin, and then you pay the people. And I said, well, where'd the coins come from? He said, well, the government made them. I said, well, how did anybody get a coin to pay the tax? He said, so they pay the people first, and then they pay the tax. I go like, well, yeah, how else can it work? He grabs his head and he goes, no. And he walked away, and he wouldn't talk to me for the rest of the tour. So look, everybody in Pompeii knew how the system worked. It was fairly simple. I don't know what kind of tax they use, but I'll just say they put a tax on everybody's house to keep the model simple here. People suddenly need these coins or they're going to lose their house, and now they show up for work with the government, who can then hire the people who need these coins. And they would hire people to be sanitation and workers and public safety and whatever else, construction, whatever else they needed to keep the Pompeii a nice place to live. And they found like 20,000 coins in the street, the archaeologists. These are coins that would have been in somebody's pocket or would have been under a mattress or would have been in a merchant's money box or something like that. And so the thing is, like, how did they get there? Okay, well, it came from the government. The government, people came and worked and earned more coins than they needed to pay the tax. So maybe the total tax in Pompeii over the period of time had been 80,000 coins, and people had come and earned 100,000 coins, and the government had paid them out of their coin box. It doesn't cost them anything. And they spent 100,000 and 80,000 were used to pay taxes, and the other 20,000 remained in the street, okay, where the archaeologists today are finding them. And what I'm going to be explaining is it's the exact same thing today, except rather than coins in the street, today the street is cash plus reserves plus dollars in security accounts at the Fed. A similar story, which was only a few hundred years ago, a couple hundred years ago, the Europeans wanted to grow coffee in Africa. So the British would come in, and how did they get people who were not monetized, who were just hunter-gatherers, I guess, who were all fully employed doing what they were doing? How'd they get them to come work in the coffee plantation? Well, what they did was they put a tax on their houses. They called it a hut tax. And they came up with some new script. It didn't matter what it was because nobody had it anyway. And let's call it the crown. They said, every hut has to pay, I don't know, 50 crown a month in taxes, or else we're going to burn them down. It's coercive. The military was there. They're ready to burn it down if you don't pay your 50 crown a month. The people are there. Okay, what do we have to do to get the crown? Oh, come on down to the coffee plantation and work, and we'll pay you 1 crown a day or something like that to grow coffee. And so people did that. And so let me skip to the sequence, which both of these examples show. And again, this was well known by everyone up until a couple of hundred years ago. Somehow the knowledge got lost. The sequence was, number one, the government wants to provision itself with labor. So how do they do it? Number two, they put a tax liability in place, a hut tax in this case, a house tax in Pompeii. Okay, that creates people looking for paid work in that currency they need to keep their house from getting burned down. People looking for paid work called unemployed. That's how we define unemployment, people looking for paid work, not people looking to volunteer for the American Cancer Society. And so the tax liability by design creates unemployment. And I'll come back to that later. Next, the government can now hire the people it costs to be unemployed by offering them jobs that pay in this currency they need to get their taxes paid. So number three, I guess, they get hired, next line in the sequence. Next, they get paid, and then they pay the tax. That's the end of the line, is a tax payment. So that sequence is the MMT money story, and that is unique today in the various schools of economic thought. Okay, deficit spending. They all knew what that was. That was when the government spent more than it collected in taxes. The British always paid the people more than they subsequently paid in taxes because they would save some. They'd keep some in case they couldn't work. They keep some to run the economy. Pompeii had 20,000 coins in the street. That was the public debt. Those were I don't know what the annual deficit was, but somehow it added up to the 20,000 coins found in the street, probably a whole lot more than they haven't found. And that was the money supply in Pompeii, the net money supply, and it's still the net money supply in the economy today. And of course, it's not something you pay back. It already is the money. So when they say, how are you going to pay back the debt? It's not an applicable question. It is the money already. It's dollars in accounts at the Fed, reserve accounts, securities accounts, and green account statements called actual cash. So we've covered that. We covered the public debt. I'm going to skip to interest rates. Pompeii did not pay interest on those coins. Why would they? Why would they want to borrow the coins back? So they didn't pay interest on them. The British, when they and the French, when they went into Africa and spent more than they collected, they didn't pay interest on it. Historically, there's always been a zero rate policy, permanent zero rate policy. Interest rates is something relatively new in this case, and you can trace it back to the gold standard, which was a fixed exchange rate. What I've been describing here are floating exchange rate regimes, which is what we have today. A fixed exchange rate would have there are differences, okay? There are important differences. If you look at Austrian economics, for example, they're not wrong. They're just applicable with fixed exchange rates. They're not applicable with floating exchange rates. Okay, and then let me say one more thing about interest rates. If they decided to pay interest on the money in the street, what would have happened? Okay, why would he even do that? For one thing, if people could get money as interest, they'd have fewer people showing up for work to earn coins. So what you're doing is you're paying kind of a basic income for people who already have money and don't need to work anymore. So it's kind of a peculiar policy to do with a floating exchange rate, but we do it, and it's an anachronism, like I said. Inflation. This is also a critical MMT understanding, because what I've described is a currency as a public monopoly. The government has the coins as the script that the economy needs to keep from getting its houses burned down. It's coercive. Okay, and so the government is the single supplier of that which is required to pay taxes. That makes it the monopolist, the single supplier. It is price setter. It is pitching, and the economy is catching. It tells the economy what it has to do to get the funds that they need to pay the taxes. So if, for example, Pompeii said, we're going to pay 1 coin a day, that's what you get, and people have no say about it. They show up, you earn 1 coin a day. Now, the markets will immediately translate that into pizzas or something like that. And so the guy who wants to make pizzas and doesn't want to be a police officer, he may decide, the other people want to be a police officer and earn a coin every day, and they don't want to make pizzas. And so there'll be a market forms, and maybe you can make, I don't know, 10 pizzas in a day. And so 1 coin may turn out to be worth 10 pizzas. And that may vary depending on, a lot of things, but let's just say it's 10 pizzas. And so you get the government giving the market information. 1 day's work is worth 10 coins. And then that gets filtered through the market forces, and all the other prices describe relative value. Markets can describe relative value. They can't describe absolute value without external information. And that external information comes from the government setting prices or accepting prices when it buys things. Now, that will stay the same forever unless the government changes the price that it pays these police officers. So if it's paying 1 coin a day, that coin will be worth in relative value of a police officer's 1 day's work. Now that relative value could change. It might be 12 pizzas or 8 pizzas, depending on pizza technology and everything else. But 1 coin will buy 1 police officer for 1 day, forever. Now, let's say and so that's what I call setting the price level. The government is setting the price level at that point. Everything else is reflecting relative value. Let's say they decide to pay the police officers 2 coins a day. Well, now a coin only buys 5 pizzas. So what they've done is just cut the value of the currency in half by paying 2 coins a day. You can earn a coin in half a day instead of a full day. The government has what they used to call cried down the value of the currency. Okay, so the price level is necessarily a function of prices paid by government based on what they're buying at the margin, and that gets flows through the economy as the market forces express relative value. So the price level will not go up unless the government increases what it pays. Everything else is just a relative value shift. Now, institutional structure, which also comes from the government, also affects relative value. So it's not quite as simple as I put it down there, but that's the basic understanding. Okay, these things were already known. Okay, you can see it in the story of Pompeii. You can see it in what the Europeans did when they monetized Africa. But that knowledge has been forgotten, as evidenced by what we're going through today with our monetary systems globally. Okay, so next slide. Okay, The MMT money story is new to us today. It would not have been new 2,000 years ago in Pompeii. It would not have been new 250 years ago in Africa once the British had come in. Okay. Coercive taxation is the cause of unemployment. That's new from MMT. I've talked to several, more than one, many Marxist economists. I said, did Marx understand this as the cause of unemployment? And they said no. Okay, this is a contribution to the school of thought by MMT. Did the British understand it? The French, when they went into Africa, did Pompey understand it? Probably, but for us, it's new today from what we've known for the last couple hundred years. Monopoly price setting. This is a new contribution from MMT. None of the Keynesians or Austrians or anybody else recognizes the price level as a function of prices paid by government. The latest, it used to be money supply. That didn't work. Something else, I forget, that didn't work. And now it's become inflation expectations by default. And just the last few days, I saw that a Fed research paper came out that said inflation expectations through their research has nothing to do with the prices at all. So there isn't a theory for the price level in mainstream economics now. The idea that the currency is a simple monopoly, monopolists are price setter, there can't be any dispute to that. That's an original contribution. Interest rate policy. I've been saying for a long time, since at least the 1980s, that the Fed and all the other central banks have it backwards. When you raise rates, you are paying basic income to people who already have money, you're increasing deficit spending, you're adding aggregate demand. And the larger the debt to GDP ratio, and the shorter the duration of the public debt, the more sensitive this channel becomes. So a rate increase increases government spending, which adds aggregate demand, which is an inflationary expansionary bias. It's all on the demand side. There's nothing on the supply side. It is what it is. Okay. The other thing is, if you look at the term structure of prices faced by agents today, which I argue is the actual academic definition of inflation. What do we have to pay now? If I'm a goldsmith and I want to buy gold for delivery a year forward or 2 years to run my business, or I'm a gold miner and I want to sell make an investment, I'm not going to have production for a year or two. I want to know what price I can get now in a year or two. That's the term structure of prices. That is almost entirely a function of rates. It's the difference between spot and forward is the rate. It's the policy rate set by the central bank. The term structure of policy rates is determined either directly by the CB or by the market's perception of CB reaction functions, plus some kind of a risk adjustment, depending on the rate you're looking at. So we've got those two channels that tell me that, number one, that you raise rates, you're adding to inflationary forces, you're adding to expansionary forces through interest income channels. And number two, that the policy rate, the term structure of prices itself is the inflation rate. And when you raise the policy rate, you're increasing the rate that term structure of prices continuously increases by. Okay. And the price level in inflation, the same thing. The price level is based on it's a function of prices paid by government. The price level only changes. Notice I'm not calling it inflation, I'm calling it the price level. That's a function of prices paid by government, just like Pompeii increasing the pay for its police workers. All it does is revalue the currency downward. The same thing happens. The price level changes when the government at the margin changes the prices it pays. And if it does it on a continuous basis, you could say that under some definition of inflation, it is continuously inflating the currency. However, under the academic definition of inflation, which is the term structure of prices faced by agents today, that is the term structure of policy rates. Okay, next slide. Something borrowed. Well, I've already done a little bit of that. Under consumption theory, it was first printed up in something like 1598, so it wasn't new. It tells you something very simple. It's an accounting identity. And that tells you that it talks about what I call an unspent income story. If you look at GDP, last year was for the US, I'll say 25 trillion. I don't know what it exactly was. That means 25 trillion was spent, 25 trillion was received by the sellers of those goods and services. So you had 25 trillion in spending and 25 trillion of income. GDP and GDI are the same number, gross one is spending, one is income. They gather them through different methods and come up with the answers are pretty close, but over time they converge, and as a matter of accounting, they're identical. So what does that mean? That means for not everybody spent all of their income. So some people earn 25 trillion in income, maybe 5 trillion of it wasn't spent. Of that income, earners, the people who earned the 25 trillion, maybe they didn't spend 5 trillion of it, they saved it somehow last year. Okay, this cannot have happened unless somebody else spent 5 trillion more than their income, or GDP, GDI would not have been 25 trillion to begin with. So what it says is for every agent that spends less than their income, some other agent must have spent more than their income. This is ex post, or else the output of 25 trillion would not have been that number. It wouldn't have gotten sold. Okay, this is under consumption theory, and it's critical to understanding that we do have a lot of unspent income. We have tax advantages for not spending your income. Pre-tax money goes into pension funds and insurance reserves and all these things. And if insufficient agents spend more than their income, which is called deficit spending, which would be public plus private together, if that falls short, then we have unsold output and we go into recession. That's what it's all about. It's always an unspent income story. And I can trace that back to the Pompeii example. If the tax was 10,000 for the year and the government spent 10,000, and some of those people didn't spend their income, those police officers, the others couldn't pay their tax, and you'd have people losing their homes unless somebody in Pompeii spent more than their income to make up for it, and they probably wouldn't have. And so the government wound up spending more than its income, spending 12,000 instead of 10,000, which it's happy to do. It got for 10,000 in taxes, it got 12,000 worth of police officers. It's not an issue for the government. It's simple arithmetic. Okay, so that's a critical understanding of today's economy, and also realizing that the private sector is necessarily pro-cyclical, which is all you need to know about a lot of economists that they tell you, credit and all this stuff. It's just pro-cyclical on the way down. They can't, the private sector can't deficit spend to cover the unspent income desire, so the public sector has to do it, or else you just keep going down. Exchange rate policy. We have fixed and floating exchange rates. This has come from other schools of thought that were very good on that. A lot of the analysis that we still use today came from the gold standards, which was fixed exchange rate policy. Economists like Fisher got it exactly right, except they're explaining an exchange rate, a fixed exchange rate regime. The Austrians got it right, except it's for a fixed exchange rate regime. So if you translate that to floating exchange rate, which we have today, then you're looking at you're describing today's economies. Now, there still are some fixed exchange rate economies, Bulgaria, Hong Kong. For those, you go back to, or you go over to, not back to, still current Austrian, other theories of fixed exchange rates. Trade policy and real wealth. This is very old also. In fact, it was in one of Krugman's early textbooks. Your real wealth is your pile of stuff. It's everything you produce domestically, plus everything you import makes your pile larger, minus everything you have to send away. And the difference, X minus M, is exports and imports is real terms of trade. You try to make your pile as large as possible in real terms. Okay, so number one, you want to sustain domestic full employment to have your pile as large as possible, regardless of what's happening. And you want to optimize your real terms of trade, get the most for your exports to optimize your real wealth. And then the job guarantee. This is been around for a long time. What MMT did was answer the question of how are you going to pay for it, and updated the understanding, which is taxation creates unemployment. If the government doesn't hire all the unemployed that it created with its tax, there's an obligation there. It didn't do this deliberately. The British didn't go into Africa and tax 10,000 on the hut tax and then only spend 8,000 so they could go out and burn down a bunch of homes. That wasn't the point. The point was to grow coffee. So they would let people earn enough to pay the tax. We don't do that. We don't let people earn enough to pay the tax and to meet their savings desires. The evidence is that there's unemployed. There's still people looking for paid work. If you look at it from a macro perspective, the economy as a whole, the only thing that can happen to funds the government pays is they either get used to pay taxes or they don't. And if they don't, by 3 o'clock, they're sitting in a bank account. That's part of the net savings, net financial assets in the economy. It means unemployment is the evidence that the spending has not been enough to cover the tax liability plus the savings desire. They're caused by government policy, by design, whether they know it or not. And so the point is, all right, if you don't want to hire all the unemployed, if you want to hire them, fine, just go hire them. If you need more people in the public sector and a green new job, fine, just go hire them. But if you don't want all of them, there's an obligation to transition them back to the private sector where the government extracted them from. And you do that either by lowering taxes, in which case the private sector will have more aggregate demand and hire them, or you hire them directly, as I just said. The problem with just lowering taxes is the unemployed have become damaged goods because private sector does not like to hire people who haven't been working. It's risky to hire people you don't want to have to let them go. It's a costly process if that happens. And so they prefer to hire people already working. And anecdotally, coming out of the last recession, there were ads for unemployment, or job ads that said help wanted, wanted people who are already working. They just don't want to hire the unemployed. So by putting them in a transition job, is what I call it, the job guarantee, where they can come in, they can work, they can have a track record, they can show that they're not on drugs and that they get along with people and the supervisor will recommend them, they will be hired very quickly into a growing private sector that's being nurtured with higher levels of aggregate demand. And there are lots of examples of this. There's India for the Rural Poor Program, and then Argentina in 2000 for the FSA Hugar program, which came from MMT scholar set that up, Daniel Kosar in Australia. Okay, what do we have next? Okay, what has rung true with the government here? Federal checks don't bounce. They picked up enough MMT last year to write checks for $5 trillion and never even discussed to pay for. And the checks didn't bounce, and we didn't get inflation. Donald Trump cut taxes by a couple of trillion. There was no ramifications. The national debt went to 11.7 billion, trillion, zillion, or whatever it was, and nobody even paid any attention. And therefore, what's ringing true now is that unemployment is a policy choice, and those are the debates now in Congress. And I'll leave it at this. I think I've covered enough to get the questions going, and usually most of the good stuff comes out in Q&A anyway.
It does, and that's great, Warren. Thanks for opening there. Did you want to quickly just run that poll just to get a flavor for the audience's feel for this? So folks, Peter's just going to run this. When did you first become aware of modern monetary theory? Last year, a couple of years ago, 4 to 5, 5 to 10, more than 10. Just very quickly have a vote there. It's a very opinionated audience, Warren, but they do tend to answer very quickly. So we're just to launch that poll there, just to leave it up something. We've got most of the audience have already voted, as I'd expect.
Let me say one other thing. When I started coming to these understandings 30 and 40 years ago, it was at a time when I was visiting people at the Fed, people in monetary affairs, guys like Vince Reinhardt, who was Greenspan's right-hand man, and then Bernanke's. And let's see, during the last year. Very good. So
obviously quite a bit, half the audience, 55% in the last 3 years. So
it's moving 50% in the last couple of 3 years. So it's definitely on the understanding is spreading. Thank you very much for that.
Yeah. Well, a couple of things.
Look, all these people, Vince used to help me write my speeches. Okay, all the guys in Fed operations know this. There's nothing to talk about. Oh yeah, of course, you can't do a reserve ad without doing a reserve drain. That's what we do. We offset operating factors. So they all know all this, and it's just like really eye-opening to see that. Go ahead.
Good. A few things. Let me just try and summarize it almost too succinctly. But the core of the argument is that money is tax credits that we trade with one another. Is that correct?
Yes.
Good. Yeah, that's kind of what I was after there. Now, your view on fixed exchange rates, I'm afraid I got a little confused in there. Are you basically saying floating exchange rates are really where you have to go with this, and that there's no problems with them?
Well, they both have their place, but for today's policy goals, you can't achieve your policy goals. You can't sustain full employment with fixed exchange rates. with a fixed exchange rate, the object of conversion is what gets fully employed. So if you're on a gold standard, gold is fully employed because there's always a bid for gold. If you fix gold at $1,800 an ounce, anybody can dig gold and sell it at 1,800. So it's like the old bimetal problem. You can't have two buffer stocks because you're going to lose one and gain the other. Okay, and so you got to let that go if you're going to pursue a full employment policy, which is how you optimize your real wealth with full employment plus, optimizing real terms of trade. So if that's your political goals, you don't want a fixed exchange rate.
Good. Well, actually, I find it interesting, your Pompeii story. We have a great pamphleteer blog done by Nick Goddard about 10 years ago where he tracked the drachma, which is what Alexander paid a hoplite for back in 300 BC or whatever. It transpires that the value of a drachma is about what we pay a British soldier on an average day today, believe it or not, a few £100. So how funny.
Yeah.
And Warren, this is from John Meyer. You've often expressed the idea that higher interest rates actually are potentially inflationary, and that orthodox viewpoints around this are back to front. Could you just explain that again?
Yeah, so let me start with two channels, the interest income channels. The government is a net payer of interest to the economy. So in the economy, for every dollar borrowed, there's a dollar saved. For every dollar borrowed borrower, there's a lender. And so when you change rates, you're just shifting it back and forth between borrowers and lenders. And presumably there's some difference in the propensities to spend interest income which causes rate increases to cause things to happen. It's not just they don't both react the same. And there's a guy at the Fed I used to visit all the time named Steve Olander, and he used to study this. And I'd ask him, what did you find? He says, well, the econometrics shows there's very little difference. We believe there is a bias towards lenders, so when we raise rates, it is tightening, but I can't detect it in the econometrics. Okay, well, so in addition to that, you've got the government now, debt to GDP is 100% and more in a lot of countries, is a net payer of interest, and it's a very large net payer of interest. So, for example, when Bernanke was cutting rates and they went from 5 something to 0, government spending was cut by $400 billion a year in interest. So that's like a fiscal drag on the economy. And I had this conversation in the mid-90s with the Bank of Italy. They had to cut rates from 12 to 3 or something like that to get into the European Union. They were afraid it would be highly inflationary and the currency would go down. And I said, look, I don't think so. I think you're going to be, your debt to GDP was 125%. You're going to be cutting 10% of GDP, cutting your spending, your core government spending on interest by 10% of GDP. When you do this, that's going to have a deflationary bias. It's going to increase unemployment. It's going to keep the currency firm, and it's going to, keep inflation down. It's not going to raise it. And you're going to look like the rest of Europe with a weak economy and low inflation, and you'll get into the European Union, no problem. And that's kind of exactly what happened. And they told me they wrote a paper on that in Italian, and I never did see it in 1996 or 7 and published it.
Now we've got a couple of questions about inflation and a couple of questions about employment. Let me start with the inflation. This is from John Falk. My grandfather, Oswald Falk, and a trading partner with Maynard Keynes, had a great phrase: better a decade of inflation than a cycle of decay, said in the 50s. So comments on that. But equally, Kiefer Weisselberg asks, is it correct to say that taxation prevents inflation?
Okay, so I'll work backwards. Taxation will, creates unemployment, lowers aggregate demand. So if what you're calling inflation comes from excess aggregate demand, then yes, raising taxes would cool down demand. Okay, but look, I've been around for 72 now. I've been around for a long time, 50 years watching this stuff. I've never seen an inflation caused by aggregate demand, including this latest one. Okay, I've seen OPEC raise oil prices from 3 to 40 in 10 years, and we had a huge cost push inflation. No one oil broke, the inflation broke. So that's not inflation. Okay, that's shift in relative value because of a foreign monopolist and that type of thing. And then latest supply issues. We're not up here from overspending. Okay, prices are rising 5%, whatever they've done, for other reasons, from supply reasons. So yes, taxes can lower spending, but that's not causing inflation. Right now, oil prices are going back up again. You look at the Saudi OSPs, they're back in price hike mode. I don't know how far they intend on going, but in 2008, that was a catalyst that knocked everything down. There are a lot of other weaknesses, but that was the one straw that broke the camel's back. We got up to $155 oil or something like that. and seems to be forgotten. So now we'll go back to the thing about Keynes, where it's cycle decay, and the answer is yes, in real terms. So what you have is inflation is not an economic problem, it's a distribution problem. In an inflationary period, somebody wins, somebody loses, but it doesn't cause real output to fall. There have been studies that checked rates up to 40% and showed that they couldn't detect any weakness in the economy because of inflation. If anything, with higher rates of inflation, the economies were stronger. So inflation itself is a political issue. People hate it. They will throw you out of office for it. If you have 90% of the people working and 10% unemployed, those 90% are pretty happy. They can hire a plumber pretty cheap because these guys are having trouble finding work. They can get their nails done, for $40, and all of a sudden there's full employment, and then they got to pay $70. So you've got people who are working. People are selfish in that manner, would rather have high unemployment than inflation. And so it's entirely political, and it's it's human nature to be anti-inflationary because of that dynamic I just gave you. So even now with high unemployment, people are screaming inflation and the Fed's causing inflation and all this nonsense, and this infrastructure is going to cause inflation, and those are the buttons they're pushing, even though we've got very high unemployment and it's working.
Well, let's turn to unemployment then. Matthew Leach is kind of curious. Can we really say that taxes cause unemployment? Surely there is always work to do for each other to support our lifestyles, and funding public work is just another reason for doing useful work and getting money. He also goes on to say sometimes governments struggle to keep their workers because the private sector pays more. What's going on there?
Right. So, okay. So, yes, taxes cause unemployment. If you don't have a monetary society, then you don't have any unemployment. You go to any, like Africa before the British went in, there was no unemployment. You went into a village, there was nobody sitting around waiting for somebody to pay them to work. Everybody was doing something. The grandmother was taking care of the kids and helping to pick berries, and the men were doing what they were doing. And you go to a sheep station out in Australia, and that's removed from civilization. There's no unemployment. The 10 brothers are out plowing the fields, and if somebody hauls a tractor out there, so they only need one or two of them, the others are not doing nothing. They're building the fences or teaching school or living their lives. There's always more work to be done than there are people to do it. So unemployment is, as we define it, is people looking for paid work who can't find it. And you have to have money, or else it's not an applicable concept. And so it's a little bit of a definitional thing, but what taxation does is causes people to need the funds, the money that the government's, specifies in the tax liability. The currency is defined, the tax credit is defined in the tax liability. It causes a need for tax credits for the further purpose of provisioning government. How else is the government going to get people to, serve in the army or, part for guys who just want to get away from their mothers and fathers? But how are they going to do that? How are they going to get a legal system? How are you going to have public education? How are you going? You can ask for volunteers, but it's not a strong solution. Today's government needs a coercive method of getting people into the public sector, and its taxation creates this dire need for the currency, the tax credit. Now they can spend their tax credits, their otherwise worthless tax credits, to provision themselves and get people into public service.
Okay. Now, Matthew actually goes on with a question that I would have liked to have asked, so I'm pleased he's done it. And it's this tension where we want to have lower taxes, but the whole basis of the system is a tax system. So what happens if the amount of money issued each period by a government, becomes smaller and smaller compared to the amount already in circulation? So that people are earning lots of money each year, but only a bit of which is used to pay taxes. Does that then weaken the system as a whole?
Not quite sure I followed all of that, but let's look at Pompeii. Let's say there were 20,000 coins in the street. Like, so what? Does it weaken the system? Does it mean people will use those to pay tax and they won't show up to be police officers? Well, it might. It might, but generally speaking, a growing economy needs a growing net money supply. As Pompeii grew, the money in the street, I'm sure, went from 1,000 to 5,000 to 10,000 to 20,000, and it might have gone to 30 or 40,000 in a few years without the volcano. And so in the United States, we have net money supply of 28 trillion. It's people are still desperately looking for money, looking for jobs, looking for work. We've got 800,000 people a month being hired who've been looking for paid work and would otherwise do it if they didn't need the money. So they need this desire to save is psychologically, almost like a scar, that's put there by the tax liability, the coercive tax liability. It causes almost all this greed and whatever you want to call it for money. This hunger for money is caused by this insecurity, this anxiety that ongoing tax liabilities instill into a society. It's a very powerful thing, and it causes enormous levels of output and innovation and everything else. And it's kind of like, beating yourself with a stick to get yourself going, right?
Now, Ian Harris here, the great fear that many critics of MMT have is they say it's hyperinflation. And can you succinctly just explain why MMT either differs from the policies of Weimar Germany, Argentina, or Zimbabwe, to name 3 examples, where that hyperinflation occurred, or is that just bad economics in the first place and not related to MMT?
Yeah, well, so let's connect those dots. So we're starting from, what's your first dot? MMT, what is that MMT in this case? Because MMT is a framework to analyze these. I wrote a paper with Phil Armstrong on Weimar, I don't know, about a year ago, and it goes through the whole thing, describes what happens through the MMT lens, so to speak. So you can see how it's all about prices paid by government for foreign exchange, for war reparations, and how that was continuously paid higher and higher prices for gold and for francs and for whatever pounds, whatever else they were required. And as soon as all that stopped, then it stopped. So it was all about prices paid by government. But that doesn't mean it's not a proposal to go out and just sell your currency on the foreign exchange market, to cause hyperinflation like Weimar. Or if you look at the banking system in Venezuela, we're making loans to insiders who buy property in Miami after selling their, currency for US dollars. And you see this guy in Miami was caught with $2 billion that he had gotten selling, I don't know how many, units of Venezuelan currency. That was one guy. Okay, it's just insane the amount of insider, corruption there that does that. Well, sure, if you want to do that, I can show you how to do it, but that's not something I propose for an economy to do. So how about you rephrase the question?
Let's move on. We've only got time for 2 more, I'm afraid, so we'll have to be quick, but I think they're both interesting. Stephen Murgatroyd, can you talk about governments losing their monopoly of the ability to create money if independent digital currencies became an example? Would this be the equivalent of returning to the gold standard?
Yeah, so if the government says you have to pay your taxes, your taxes are in dollars, so let's say it's a property tax. You got to pay $10,000 a year on your house or something. It doesn't, why would it matter if there was Bitcoin or rubles or marks or yuan floating around? It doesn't have anything to do with it. It's entirely independent of all those things. It's a separate spreadsheet. Nothing jumps on it or jumps off of it. It's just debits and credits on a spreadsheet.
I'm with you on this. I think people often confuse, like the state of Florida announced some years back that it would accept Bitcoin in payment, but it denominates it in dollars and requires it in dollars. So Bitcoin is no different than Visa or MasterCard that you use for a split second to pay.
Or paper clips. He's going to give you the market value of the paper clips and go sell them, get his dollars.
And I'm very conscious that people are talking about weird states like El Salvador, but honestly, any government that gives up its own currency is an idiot.
Well, it's just what they do is your currency is the Bitcoin might be the numeraire, use it as a numeraire or something, but they don't. It's not the currency they use. The tax liability is not defined in a certain amount of Bitcoin. Yeah. If it was, fine, but I don't see any government doing that.
And the final question, and really coming from Angel Gaviera, we'll have to be quick, but under MMT, so if we analyze using this MMT lens, what is the logical consequence of large amounts of QE that we've witnessed since 2008? And an appendum to that, which would merely be, could you explain whether or not you think the large amounts of furlough, the Kurzarbeit or whatever the subsidy programs, how is that bolstered or weakened the case for MMT?
So let me start with QE. Now, first of all, it's very different in the European Union because they're buying member nation debt, which would be like the US buying the states. debt and allowing states to deficit spend. So it's different here. They're buying federal debt. It's just a placebo. It doesn't do anything. There is no channel from QE to anything in the economy except psychological. It tells you something about what the Fed wants or doesn't want. First of all, if you're selling your bonds to the Fed, you don't even know it's the Fed buying them. So it could, and it wouldn't matter if it was the Fed or any other bank buying the bonds. If it was Citibank or Bank of America buying all those bonds, it wouldn't make any difference to the economy. So when you sell bonds, you used to have your bonds, say, account at the Fed, Treasury Securities. You had $1 million in 3-month bills or something, and you sell them because you don't like the yield or whatever. But no other reason. Nobody's compelled to sell them. It's all done voluntarily. And now you get your account credited with $1 million in cash at the Feds. It's like, so what? You're not any richer or any poorer. You still have $1 million, except instead of being in a 3-month Treasury bill, it's in cash. You could have done that anyway. You didn't need to have the Fed buying securities for that. Treasury bills buy and sell for quadrillions every year. I don't know how much it is. It's a lot. And so do all the other securities. They're all already marketable. So it's not like all of a sudden, Fed's taking my bonds. Now I have money, so I have to spend it or something like that. So if it's not spent, it's basically shifting the duration of your financial asset from 3 months to 0 or from 30 years to 0 at the going market rate, which you could do anyway. If the Fed hadn't come in, that you probably didn't even know the Fed came in, but if you did know, maybe you noticed it was a half a basis point lower yield or something than it would have been otherwise. It's just absolute nothing. And I had that conversation. Do I need to? Am I out of time here? I had this conversation right around 2000 at the Bank of England with people from the Bank of Japan. I was with Andrew Crockett there, and I asked the guy from the Bank of Japan, they were just doing QE. I said, why would you expect this to do anything? It's not like there's a line of creditworthy borrowers at your banks who, if only the banks had yen to loan, could borrow money. They go, well, yeah, that's true. I said, all you're doing is, banks are like, have fewer JGBs and more balances. It's like, so what? Why do you expect that to make any difference? And Andrew, he says, looks at him, he goes, he was a governor there. He goes, yeah, what do you got to say to that? And they all said, well, it's our policy and we'll see what happens. Well, 30 years later, 20 years later, nothing's happened, right? They've done more QE than anybody in the world. It does nothing.
We could go on, obviously, and it's great. We'll be sending you all of these questions and comments. There are quite a few nice ones here, but whenever people start saying thank you, it means, sadly, it's time to draw it to a close. 3 quick rounds of thanks, if I may, once again to our sponsors, whom you can see posted here. All of you are most kind in allowing us to range widely and freely, but I hope you see that, like us, we do believe MMT needs to be taken a little bit more seriously by the mainstream than people are giving it credit for. Personally, I find it a very helpful analytical framework. Secondly, if I could, I'd like to thank you, the audience. You've been particularly vibrant today, and so thanks for that. It makes my job very easy, just field the questions to you. Thirdly, we do have a lot of things coming up. As you can see, as ever, just check out the website. But Monday, you'll get to figure out what halophytes are. We've got a lot on climate change, innovative tax technology, and one of my favorites, sort of asynchronicity here in the post-pandemic world. So lots coming up. But my serious thought is very much to you, Warren. Thank you so much for breaking your tennis just to come and be with us today and to share this thinking. We will be circulating all of Warren's links, so please do read these papers. They are intriguing and well worth serious consideration. Unfortunately, Warren, I'm unable to open the technological floodgates of applause using this system, but I can assure you it is sincerely there. And so on behalf of the audience, if I may, I will say thank you so much for coming on.
Thank you for the opportunity.